the legendary Sachin Tendulkar says, mutual funds sahi hai.
Long-term investing.
Our favorite kind.
That's my favorite kind because I really honestly truly believe that nothing in this country gives you the kind of returns that equities have given and continue to give.
You don't have to go out and buy all the different expensive stocks yourself. You can just buy the Cadbury Celebrations box.
That's amazing. I think I've never really thought of it that way, but this is a great way for you to put it.
What, according to you, are the top 3 or 4 things that you keep in mind when you choose a mutual fund? Hi everyone, I'm Sayali.
And I'm Niyati.
And welcome to the Finance Happy Hour with FinCocktail.
And today we're going to talk about mutual funds and why they're literally appropriate for everyone.
Like the legendary Sachin Tendulkar says, mutual funds sahi hai. But sahi kiske liye hai? For everyone? Do you think so?
I think so because there's so many sort of categories and options within mutual funds that you can sort of find the right fit for you. But before we get into that, let's backtrack a little bit and really explain what mutual funds are. If I were to simply ask you to say it, in as few words as you can, what are mutual funds?
Okay. So what mutual funds are just a basket of securities, stocks, bonds, etc., different types of financial securities that experts pick and put together to make life easy for you. So I love giving this example. I don't know when I came up with it, but it's stuck in my mind. So you know how you have a Cadbury 5-star or a big eclair or those big Cadbury silk bars. Each of them individually are quite expensive.
Correct.
But now Christmas is coming, Diwali just went, etc. They have these Cadbury Celebrations boxes that have these mini chotu ones
of all the different chocolates.
Yes, and the Cadbury Celebrations box is much cheaper than buying those individual, big chocolates. But you get a flavor of all and much cheaper. So that's kind of like mutual funds.
Correct.
You don't have to go out and buy all the different expensive stocks yourself. You can just buy the Cadbury Celebrations box.
That's amazing. I think I've never really thought of it that way, but this is a great way for you to put it. Mutual funds are like a Cadbury Celebrations box.
Yes.
I love that analogy. Amazing.
Yeah, so I think they just make it easy for you and they're picked by experts. So they've been around for a while. They have all this research that goes around behind picking the individual securities in a particular mutual fund.
Right.
So I think that is why a lot of people are behind mutual funds also.
Absolutely.
They stick by it. We do. We love mutual funds.
We are like ardent sort of supporters of mutual funds.
100%.
So I absolutely agree
how
with
much
you.
percentage of your portfolio is in mutual funds?
I would say about 70-75% of my portfolio is in mutual funds.
Nice. Mine is closer to 85.
Yeah, I'm not surprised. Yeah.
So we clearly are big on mutual
funds. And I think the great sort of advantage of investing in mutual funds is that, first of all, as we've been in the field of finance,
yes.
We've studied finance, we've been around people in this field, and yet researching a stock and picking the right stock is such a challenging task, isn't it? I mean,
it is.
It's something that requires patience, effort. It requires you to be in front of the screen 9 to 3:30, sort of just tracking where the market is at, where your stock price is at. Has it gone up? Has it gone down? Do you think it's the right time to enter? Do you think the future sort of prospects for this particular company are good, bad? There's so much analysis that goes behind picking a stock that even though we are from the field of finance, it's something that we don't prefer doing on a daily basis. 100%. We have day-time jobs which take a lot of our time.
Correct.
And I don't think that we'd be able to do justice if we were to research stocks for like a couple of minutes a day and then make a decision to buy a particular stock or not based on that kind of research.
Correct.
So I think that mutual funds are a great way to participate
Mm-hmm.
in the stock market or even in the bond market or various securities
Mm-hmm.
without having to put that kind of time and effort
Mm-hmm.
that requires to do that kind of research.
100%. Especially if you look at it now, let's say majority of the country now doesn't have that kind of time to sit in front of a trading terminal and understand investor sentiment for every stock or every bond.
Correct.
They have jobs, they have EMIs they have bills to pay, they have families to take care of.
Correct.
So I think that's why mutual funds come as a savior.
Absolutely, and we're just talking about the technical analysis bit, right? Where you're sitting in front of the screen trying to track the price movement. But there's so much fundamental analysis also that goes behind picking a
100%.
particular company
100%.
to invest in.
Yeah.
You don't have the wherewithal, you don't have the bandwidth, you don't have the sort of patience to do that on a daily basis. And I honestly, truly believe that investing in the stock market based on some random tips that you got from like a friend or an uncle or chachaji is not the way to make money, because more often than not people tell you when to buy something. Nobody really tells you when to get out.
Yes.
Nobody really tells you that this should be a holding period, this should be your target price.
Yeah, 100%.
Nobody tells you these things. They just tell you, "Acha, ye kharid lo.
ये चांद तक जाएगा."
But then what? खरीदूं for 1 साल, 5 साल, 10 साल.
Exactly.
Retirement तक कभी तक रखूं ये stock. Nobody tells you that stuff.
100%.
So it's important that if you're not an expert and if you don't have the bandwidth to do that kind of tedious research, you stick to investing in these asset classes through mutual funds.
Yeah.
Because they take care of all of that stuff for you.
100%.
You don't have to go through the headache.
Yeah.
What you need to do is pick a good fund manager, choose something that fits your goals, and then invest.
Yeah.
And then, continue. There are various ways of investing in mutual funds. You
Correct.
can do a lump sum investment, you can do SIPs, you can do weekly SIPs, monthly SIPs. There's so many options.
Yeah. So a lot of people have this myth that, SIP में invest करो या mutual fund में. They don't understand that it's the same thing. SIP is not a type of investment. It's a way of investing. Now, for example, आपको गोवा जाना है. Okay, सबको गोवा जाना है लाइफ में कभी ना कभी. अभी भी I swear to God, there'll be 3 groups जहाँ पे प्लान बन रहा है गोवा जाना है. But अच्छा ठीक है, गोवा जाना है. कैसे जाएंगे? फ्लाइट से जाएंगे, गाड़ी चला के जाएंगे, ट्रेन से जाएंगे, बस से जाएंगे. There are so many options. But point क्या है? गोवा जाना. So that's the same thing. SIPs is a way of investing in mutual funds itself.
Yeah,
mutual fund is Goa.
It's a way of reaching Goa.
Yes, it's a way of just reaching Goa. Systematic investment plan, that's what it's called. SIPs are systematic investment plans. It's a way of investing your money in a disciplined manner in a particular mutual fund scheme. That's it.
Correct. You're just staggering the payment as opposed to putting in money all at once.
Yes.
That's what an SIP does.
Yes.
Now, whether you choose to stagger it in a monthly manner or weekly or fortnightly, that's really up to you.
Exactly.
The mutual fund gives you that option to choose what suits you the best to invest in a disciplined manner over time. So I think it's very important that we address this right in the beginning.
Yeah, 100%. And I think it makes a lot of sense for people who, again, are starting off in their career, have a job or a particular monthly income. If they want to do an SIP, it makes sense because they can just account for it in their monthly budget.
Absolutely.
So that every month the investment will just sort of keep going.
Correct.
But going back a little bit, mutual funds are for everyone, 100%. But how do you know which type of mutual fund is for you?
Absolutely.
Correct. And this is where your famous buckets come into play.
Yeah, my famous buckets, which I have, guys. I've spoken about these buckets in, I think, a few videos ago. I've spoken about these buckets. Yes. So let's backtrack a little bit and revisit my famous 3 buckets of long-term, medium-term, and short-term. It's very important to categorize your goals in these 3 buckets. But once you've got your goals categorized in this sort of simple framework, it becomes rather easy to pick which mutual funds fit those goals.
Correct.
Okay. For example, if you have a short-term goal of under 1 year of taking a holiday at the end of the year. You want to go to Italy at the end of the year. You know that, I know it's a dream to travel right now, but anyway, if you want to go to Italy at the end of the year, you know you're going to need probably 3 lakh rupees. That's your short-term goal. How do you really reach that goal? By investing. Because money lying in your savings account is really not the most optimal way of sort of
growing it.
It's not growing, it's degrowing.
Yeah.
So you invest it. Now, for short-term investments of these kinds, what comes into play are debt funds. Now, debt funds have this particular category called liquid and overnight funds. They are funds that invest in ultra short-term kind of papers, which essentially means that your money is invested for a short period of time. And that is what you should consider when you're looking to achieve your short-term goals.
Correct.
Look at liquid funds, look at overnight funds, you look at ultra short-term bond funds. These are the ones which will help you achieve your goal while making your money grow at a very sort of stable rate.
And keep it safe.
And keep it safe. It's not, the returns aren't going to be super normal. If you're expecting 20% plus returns, not going to happen here. You'll probably get that 5-6%, tops 5%. But it keeps your money safe, it keeps your money liquid, and it grows it steady.
Correct.
So when it comes to short-term goals, I think debt mutual funds, especially liquid and overnight funds, are a great option to consider. Then when it comes to sort of medium-term investing, okay, you have goals that you need to achieve in the next 3 years. You're okay to park your money aside for 3 years. Now, 3 years is a very in-between sort of time frame to invest in equities. Because with equities, what happens is that sometimes you're caught at the wrong end of the cycle. And sometimes these cycles last very long. Where the entire overall market is not doing well.
Let's take last year, for example. There was so much volatility. If that was the end of your third year, I mean,
you would have literally ended up losing a lot of money.
Exactly.
So for your medium-term goals up to 3 years, I would definitely recommend debt mutual funds again. But there are various other categories called corporate bond funds or short-term income funds. Now, these are funds that invest in corporate bonds, typically. And these are funds that give you that return which is slightly higher than 5%. You'll probably end up getting 7.5% here. But they also give you that peace of mind that your money isn't going to go negative.
Correct.
Because with equities, you're always taking that chance. At the end of 3 years, you don't know which end of the market cycle you're at. And if you're at the bad end of the market cycle, even your investment cost would probably not be recovered.
Correct.
You could be below your investment cost, which essentially means a loss. Okay. So, if you know that you need a goal achieved in 3 years, I think short-term income funds, corporate bond funds, target maturity funds, these are good funds to consider from that perspective. And then when it comes to long-term investing,
our favorite kind.
That's my favorite kind, because I really honestly truly believe that nothing in this country gives you the kind of returns that equities have given and continue to give.
Yes.
So equity mutual funds are a great consideration for long-term investing. There's also other funds that you can consider, probably, just to diversify your portfolio, you could consider gold.
Yes.
There are funds that invest in gold that you can consider for this.
A lot of people don't know this, but there are mutual funds that invest in commodities like gold.
Yeah, absolutely.
So,
and those are great to consider from a diversification perspective as well. But, when you're just starting to build your long-term portfolio, a good mix of index funds, large cap funds, a little bit of multi-cap funds, and a little bit of exposure to small cap funds might be the best way to sort of design your portfolio.
In the beginning.
Obviously, as you move ahead, you need to sort of change this sort of allocation depending on your goals, depending on what long-term really means for you.
Yeah.
Long-term for me might be 7 years, but for you it might be 10 years.
Yeah.
For somebody else it might be retirement.
Yeah. 15, 20 years from now.
So long term also is a very sort of broad time frame that we talk about. But really, depending on what long term means for you, you can design your portfolio, your equity mutual fund portfolio, to be able to achieve the various goals that come for you.
Correct, 100%. So I love saying this, but you mentioned index funds, right? So let's start with that. Because within equity funds also there are so many categories, right? And a lot of people don't know the different categories. Let's start with index funds because they are my favorite. They have given me a great steady return in my current, which was long term 10 years ago. And I personally love index funds. I have a lot of money invested in index funds for my retirement. I'm like 20 years not looking at it.
Correct.
And what these index funds do essentially is just, they are what we call passive funds, right?
Correct.
They don't, essentially the
fund manager doesn't really have to pick and choose stocks. He just has to replicate the index.
Yes. So they have, like, you have the Sensex, you have the Nifty, you have different types of indexes. And they just pick one, let's say Sensex, and they say, acha, isme kya hai, and copy it and done. Okay, there's obviously some margin of,
balancing out.
But what they do is they just try to replicate the index. They try to replicate the returns given by the index by investing in the same stocks and bonds in the same proportion.
Absolutely.
Okay. And now, whenever we have like money control notifications going and saying, Sensex at an all-time high, that means that ideally your whichever index mutual fund you've invested in, that will also be at an all-time high.
Correct.
So if you want exposure to that particular number, great option. And since the indexes sort of reflect the financial health of our country usually,
correct,
it's always a good idea to have one in your portfolio.
Absolutely, I couldn't agree more. An exposure to index funds as a part of your equity mutual fund portfolio is essential. Because even if your actively managed funds don't do well, and the economy is continuing to do well, your index fund will replicate the performance of the index and give you that return. So you will be able to participate in the performance of the economy.
Correct.
Even if your actively managed funds aren't doing well. Correct. Plus, they have a very, very low fee, which is the expense ratio, because the fund manager isn't really picking and choosing stocks and deciding what proportion that's supposed to be invested in.
Correct.
So the fee is also pretty low. So I think it usually is between 0.3 to 0.5% for index funds, which is great. It's not a big fee that you're paying. So having a small exposure, I don't know whether small is the right word, but having an exposure to index funds as a part of your long-term mutual fund portfolio is
100%. Now let me just give perspective on this, okay? So everybody has seen the TV show Scam, right? 1992 wala. I'm sure everybody has seen it. If you haven't, please watch it because it's fantastic. In 1992, the Sensex, so they give an example, right? The Sensex, Harshad Mehta was trying to manipulate the stock market. And he took it up to 4,000. Guess what it's today, guys? It's like
almost 64,000. Almost.
Not there yet, but hopefully
someday.
Imagine, yes, I agree, it was 30 years ago, but imagine if you had invested, or your parents had invested in your name in that 4,000 index fund. Today, it would be
multi-fold, right?
It's crazy. So it's a perspective on what long-term means and how it can grow and how you can participate in the growth of the economy.
Absolutely.
Going back to the long-term equity mutual fund portfolio, we mentioned index funds, which we've covered. We mentioned large, small and mid. A lot of people don't really, they say that, invest in blue chip funds. But
what are blue chip funds?
What are blue chip funds? And what is the difference between blue chip and large cap funds?
Right. So essentially, blue chip funds are the top sort of performing companies that have been around for a very, very long time. They don't probably give you that supernormal return, but they continue to grow at a steady rate.
Correct.
they continue to grow at that 12%, 13% kind of rate year on year, because their businesses have been around for a while. They are companies that are usually in the essential sort of
services category.
essential services or goods
Correct.
category. And they're companies that have already probably achieved their supernormal growth stage, but now are at that plateau.
Yeah. And
where
there are those big companies. You have your
Nestle.
Yeah, you have your Reliance, you have your Tatas, you have your
ITC. So these
ITC.
are companies that have been around a very, very long time, and they're stocks from which you can't expect 20-30% kind of returns year on year.
Yeah.
But they're there to give you that stability in your portfolio.
Correct.
They're there to sort of give you that 12-13% kind of returns year on year, and you can bank on them for that. So having large cap funds or blue chip funds as a part of your portfolio is also very, very important.
Yeah. Just a quick clarification. Large cap, blue chip, same thing.
Yeah.
It's
pretty
just,
much.
It's the same thing. So essentially, it's how companies are categorized is by market capitalization, which is what they mean by large cap. The cap. So the large cap is the top 100 companies by market capitalization. So they're the largest companies in the country.
India.
Then you have mid cap, which is 101 to 250, if I'm not wrong.
Yeah.
101 to 250.
And anything
below 250
small
is
caps.
Small caps. So that's your 3 categories.
Yeah, and I think there's this one category which has sort of gained a lot of traction in recent times. They're called multi-cap funds.
Yes.
Because essentially,
in everything.
They have a bit of everything.
Yeah.
They have a bit of large cap, a bit of mid cap, a bit of
small
cap. the larger small caps usually. So you don't really have to get into picking various funds.
Correct.
From the large cap category, mid cap category, and small cap category. This one fund does it for you. So multi-cap funds also have gained a lot of popularity in the past few years, and I think that they're great from the perspective of a novice investor.
Correct.
Who probably doesn't have the bandwidth to even choose various mutual funds within different categories.
Yeah.
So if you're somebody who is just starting their investment journey, just pick an index fund, pick a multi-cap fund, and you should be fine. Start investing in these funds at least. And then as your portfolio grows bigger, then obviously there is a lot more to consider from the diversification perspective.
Correct. 100%. So I think that's the journey, right? You start with your index fund, your large cap, mid cap, small cap, because that's also in order of increasing return and increasing risk. That's I guess the basis of finance. More risk you take, more returns.
Absolutely.
So you have to make sure that you balance it out and you are able to take on that risk when you reach there.
Absolutely. But what according to you is okay? So let me ask you this: what was your first mutual fund investment? Like, how did you start investing in mutual funds?
Okay, I was very small when I started my mutual fund investment. I was like 21, 22. I just got my first internship and everything. And I had to spend all my money first 2-3 months. Then my mom gave me one jab. She was like, how dare you spend all your money if you don't save right now? What will you do when you're my age? So then I was not great at this. I had no idea how this was done. So she made it for me.
Okay.
She put it in an index fund, a Sensex index fund, and I've been very happy with it. It gave me great returns.
Yeah.
Yeah.
So that's what happens, I think. When you start your investment journey, you're probably investing, a very small amount initially. Like I remember I started with 1,000 rupees a month.
Yeah.
Because tabhi to yaar wo stipend hi 5,000 ka tha, so 1,000 rupees also seemed like a very large amount to invest.
1/5 of your income to went.
Correct. So 1,000 rupees se chalu hua, but over time, I think I also started investing quite early when I was about 20-21. And then over time, I have seen my portfolio compound at such a great sort of rate that I feel like if I wouldn't have started early on, I would have probably not been here.
Correct.
These little 1,000 rupee investments have contributed towards, the larger investments that obviously came along the way as well.
Yeah.
So I think one day you'll wake up like 10 years later and be like,
like,
wow, like I have a portfolio this size, like I didn't even know.
When did that happen?
When did that happen, right?
Yeah.
So it's important to continue making those smaller investments as well. And obviously lump sum investments are something that, you know, for example, you get a bonus.
Yeah.
You know, invest it into pick
Out
your
of
mutual
the-
funds.
correct.
Yeah, based on your goals.
Yeah.
And invest it. You know, don't leave it lying in your savings account, because more often than not, you're going to spend it all.
100%. And like we always love to say, hoga hi nahi to kharcha kahan se hoga?
Correct. And that's why I really have like a pro tip for salaried people who do SIPs. Make sure that you set your SIP to be debited from your bank account in the first 10 days of the month. Because if it happens in the latter part of the month, there is a good chance you're going to spend that money.
Correct. And
You know, in the
temptation.
in the first 10 days, you've just received your salary. You know, you're still like, okay, you know, I have this money in my bank account. You're not really like going crazy spending on random stuff.
Yeah.
So the first 10 days of the month is a great time for you to make those SIP investments.
Correct.
Because you're taking care of your investments beforehand.
100%.
You know, you're not waiting till the end of the month to make that SIP investment.
And then if you wait anyway, you're tempted कि
ठीक है ना, एक SIP skip हो जाएगा, कुछ नहीं, अगले महीने debit हो जाएगा.
And that अगला महीना never comes.
Yeah, then it becomes a cycle or a rut that you get caught in, and you don't want to be in the wrong side of that situation.
Unnecessarily. Okay, so we mentioned just quickly offhand about how index funds have a low fee or expense ratio, as we call it.
Correct.
So expense ratio is something that you use to pick mutual funds,
Absolutely.
right? What, according to you, are the top 3 or 4 things that you keep in mind when you choose a mutual fund?
Sure. I think I keep it very simple. For me, it really makes life easy if I look at these 3 or 4 things. One being the fund manager.
Okay.
You know, how long has he been managing a particular fund? You know, how often has the fund manager for that particular scheme changed?
Acha.
Is he sticking to his investment mandate? Is he doing what he set out to do? Or has he changed his investment strategy completely along the way?
Correct.
These are a few things that, you know, I just look at from the perspective of doing a hygiene check on the mutual fund scheme that I'm investing in. That's number 1. Number 2 is past performance. Now, this is something that, you know, a lot of people only look at. They only look at past performance.
Yeah.
I can see that past 3 years, 5 years, 7 years, this fund has given me 18%.
तो उतना मिलेगा.
तो उतना मिलेगा. Past is not a guarantee of future returns.
Never.
We all know that.
Yeah.
So, as much as it's important to look at past performance, it's not the only thing to look at.
Correct.
You know, you look at the past performance from the perspective of seeing the vintage of the scheme, seeing कि okay चलो at least 3, 5, 7 years में ये performance आया है, तो I probably can expect something in the ballpark.
Correct.
You know, in a range. So it's important to check the past performance as well, because sometimes there are red lights where suddenly over, you know, the longer term, a fund continues to underperform its peers or underperform the index.
Correct.
And those are or underperform its benchmark. And those are some red lights that you need to be aware of.
Correct.
So 3 months, 6 months, 1 year, that's not underperformance really.
Yeah.
You know, when you look at it from the perspective of consistency.
Correct.
It's not something that should be a red light for you. But over the 3-year, 5-year, 7-year period, if a mutual fund is consistently underperforming its peers, when I say peers, other funds in the same category, you know, is it underperforming the index? Is it underperforming the benchmark? Then it may be a red flag that you need to consider. You know, that's why you look at past performance.
Yeah.
And third is something that I look at, which you mentioned, called the expense ratio.
Yeah.
Now that's essentially the fee that the fund manager is charging you for doing all the mehnat that he's doing.
Yeah.
You know,
he will obviously not do it for free.
He's not doing it for free. It's not like you have to cut a separate check and give it to the fund manager. It gets debited from your investment itself.
Correct.
So, you know, you have to see expense ratio whether it's in line with
The
other funds
others.
in the category.
Correct. Is it unnecessarily
Is it
expensive?
unnecessarily expensive? If so, why?
Hmm.
Is the fund manager able to justify it with better performance?
Correct.
You know?
Yeah.
So those are a few things that I think basic you should consider while picking a mutual fund. I mean, now this is, I'm saying all this once you've figured out which sort of mutual fund schemes you want to invest in based on your goals.
Huh.
You know, which
This is after
categories,
that.
which
Correct.
categories you want to invest in based on your goals.
Correct.
But this is how you pick schemes
Correct.
within particular categories.
Correct. Now, chalo, for your past performance, your your expense ratio, etc., all of that, money control, value research, lots of websites that give you this information. What about this? We always talk about investment mandate and manager, and has he changed? Has his investment mandate, etc. A lot of people ask us where we get that information. Where do we get that?
So it's very easily available. It's the scheme investment document. It's the SID, which usually has a lot of this information.
Correct.
They'll give you the fund manager history. They'll give you a little bit of information about what the objective of the fund is.
Correct.
Has the strategy changed? Has it remained in line? It's basically out there for you to sort of just read through and understand.
Yep.
It's not something which is hidden,
It's just people don't go looking for it.
Yeah, it's just that not everyone wants to go looking for it.
Yeah, 100%. I just want to add one more thing. There may be like you must have heard, most of these things are a judgment call. Now, the fund manager experience of what he has done, again, it's a judgment call, right? So picking mutual funds, like picking stocks, is art and science together. Yes, you're looking at expense ratios, you're looking at hard numbers, but then there is also a certain a certain leap of faith that you have to take.
Yeah.
That this has worked, this has not worked.
Absolutely.
This seems to be working, etc.
Absolutely.
And which is why I think there is no 2 + 2 = 4 formula for picking the best mutual fund or picking the best stock.
Absolutely.
And if anybody tells you this is a multi-bagger, go for it, or this is the best mutual fund scheme, go for it, please don't.
Yeah.
Please don't.
Even within the mutual fund ranking space,
Yeah.
funds get ranked
on
random things, and then those rankings keep changing. It's dynamic.
Exactly.
It's not like, some fund which has been around since 2008 or 10 has consistently been the top ranker.
Number 1.
वो ऐसे नहीं होता.
Yeah.
It's
Exactly. I think that's what also people want a easy formula or an easy Excel sheet where they put in their income, their budget and mutual fund, and then it'll spit out of 5 names. Doesn't work like that. It's called personal finance for a reason, because it's personal to every single person.
Yeah.
It's dependent on your budget, on your investment goal, on when you require the money, on how much risk you are willing to take.
Absolutely.
Who's dependent on you? How many family members? Are you insured? Are you not? It's a whole mix of things.
Absolutely.
Which is why I think understanding that there is no set formula. This is a good framework to begin with.
Yeah.
And to sort of follow along.
And it's a dynamic framework.
Yes.
Which changes from time to time, and you have to keep reassessing and realigning your portfolio basis your goals.
100%. And if you've invested in a particular mutual fund, you have to go back to it to check. Ki chalo, on money control, it's saying 6 months this much, but that may not be the date you invested. Na?
Yeah.
So how is your portfolio doing in terms of how are the mutual funds that you picked?
Correct.
How are they doing?
Correct.
Has anything changed since you invested in them? Is the SIP still working for you? Should you stop an SIP, start another one, etc.? Again, all art, more art than science.
Absolutely. Agree. So I think that's it on mutual funds for now. We honestly, truly believe that mutual funds sahi hai. So why don't you guys share this with your friends who might want to start their mutual fund investment journeys?